Hello and welcome to the Mutual Fund Show. I'm Neeraj Shah. Over the next 22-23 minutes, we'll talk all about mutual funds, obviously, but various aspects of mutual funds, especially in a period right now wherein both IPOs and NFOs are very, very active and available in abundance. So I think with that as a preamble, let me welcome my set of guests on the show today. Salonee Sanghvi, founder of My Wealth Guide, to kickstart the show today. Salonee, great having you. Thanks as always for joining in and for taking the time out.
Thank you so much for having me on the show, Neeraj.
Okay, Salonee, I'm throwing this out of the dark at you because while there are some topics that I really want to talk about, the fact remains that NFOs are available and quite a number of NFOs out there. So on last count that we figured out, in the month of August itself, Franklin Ultra Short Duration, Aditya Birla Sun Life Defense Index Fund, Bandhan Nifty Bank Index Fund, BOI Business Cycle Fund, DSP Nifty Top 10 Equal Weight Fund, and if I leave out DSP 20, DSP Top 10 Equal Weight Fund, a bunch of others are out there. I would love to know, Salonee, because the principal belief that I've heard from you and some of your peers is that NFOs may not necessarily be the best place to invest in because you'd rather wait for the fund to perform and then go in. But out of the spate of NFOs open right now, is there something that has caught your eye?
I think, yeah, again, I concur with the same, that for most people, I think NFOs is not something they really need to invest because in most segments, we already have funds which have been there for the last 5, 10, 15 years. So you know exactly how the fund is going to behave during different market cycles. I think the only time that you can really or you should really look at an NFO is, if it's offering something new, either a new segment or a new strategy, which is not currently there in the market. So I think right now, I would not really look at any of the NFOs that are currently there in the market.
A clutch of business cycle NFOs out there, Salonee. Any thoughts here? Because, I mean, is it a fancy name for something that a flexi cap or a multi-cap fund would anyways do?
So again, I think for most people, a large cap, flexi cap, or a mid and small could work depending on their, allocation. Again, I think this is a very specific thematic fund, not suitable for most investors.
Okay, fair call. Well, since we're on the topic of NFOs, let me, and as I welcome in our second guest on the show today, we'll start off with the NFO conversation because there is an NFO from the DSP stable as well. Kalpen Parekh, MD and CEO of DSP Mutual Fund, with us on the show too. Kalpen, great having you. Thanks for joining in. A full disclaimer, Kalpen, Salonee, and for all the right reasons, has said that NFOs should be approached cautiously, and she believes that the fund which has established its performance over a period of 6-9 months should be the ones to invest in. I want to start off with you on the NFO since we had started off with that topic, because your house is coming out with this Nifty Top 10 Equal Weight Index Fund. So if we can, let's start off with that and talk about why is it that you've thought of this offering, Kalpen?
Thanks for welcoming me, Neeraj. As always, pleasure to be on your show. And I briefly was hearing your conversation silently with Salonee, and I think I agree with what she says that at the end of the day, as an investor, we need very few portfolios for our long-term investing journey. And if every month there are 20 new products in the market, partly it is to fulfill our objectives, not necessarily your objectives. So every NFO has to be seen with the question that is it changing anything in my portfolio? Either is it helping me improve the return outcomes, return probabilities, or is it helping me in reducing the risk of my portfolio? Only then, one should evaluate whether you want to look at any new idea or not, because NFOs don't have track records, NFOs don't have, live money being deployed. So that is the first disclaimer, and we completely recognize that. At the same time, if you have noticed over the last many years, the approach that we have brought to, designing a product or launching a product in the market is to launch a product when past returns are poor, because the big rule of investing is mean reversion. The iron law of investing markets is mean reversion of cycles. So generally, we prefer to bring to the market products which are in low cycle or strategies which are in low cycle, which are simple and which can make some meaningful contribution either in terms of rewards or reducing of risk. in the portfolio. Why particularly Nifty top 10 equal today? In India, I'll just give you some statistics. The largest 10 stocks, they have roughly around 23-24% ROE versus 15% of Nifty 500. And these 10 stocks, because of the last 4 years of depolarization, where a lot of money has been made in stocks away from stock 1 to 10, whether it is stock number 11 to 40, 11 to 50, 50 to 250, 250 to 500, 500 and beyond. Most of the money has been made on the other side of the market. In the last 1 year alone, the top 10 stocks have delivered 17% return, and stock number 11 to 490 have 11 to 500 have earned 51% return. So in the long term, these top 10 stocks, whatever they may be at different points in time, they are dominant companies, they are mega caps, they are the largest caps of the country, they represent some of the best businesses of the country, and they have delivered value over time. So if you see very long term returns, generally the top 10 stocks have delivered superior returns over Nifty or Nifty 500 with relatively better risk profile. And today we are launching them when they are in low cycle. We are happy to launch funds when they are in low cycle. Otherwise, in fact, you were discussing about NFOs. The construct at DSP is to launch OFOs. We have been constantly launching old fund offers. So in 2020, we launched the old fund offer of our FlexiCap fund, which had a 23-year history at that point in time. In 2021, we did an old fund offer of our Tiger fund, which is very popular today because last 4 years the returns have been stellar. So our whole idea is to launch this fund because it is in low cycle. The whole market is allocating unnecessarily, probably unduly higher capital towards small cap stocks, mid cap stocks, not even small and mid cap funds. They are collecting only 2,000 crores, but small cap stocks are taking away a lot of investors' safe capital. And we believe it is better to be in this pocket at this point in time from a risk-adjusted future outcome perspective.
Very interesting, and some of the returns have looked okay if you look at the past dated things. But Salonee, great to get your views here, simply because I know you run a small case, you invest in small caps, all of that, and Kalpen's point about how we know that the valuations at the small cap end are higher. So therefore, could there be a mean reversion to large caps over mid caps and small caps? Is that something that you're penciling in? And therefore, would an equal weight index fund be good enough? And again, by the way, Salonee, your view around why NFO should be avoided is par for the course. I'm just trying to understand, in this specific case, as an asset class, could large caps and an equal weight index do well relative to mid caps and small caps?
Right. So, as you rightly mentioned, I think in the last 6 years, mid cap and small cap has attracted a lot of attention and investment due to the returns in those segments. In fact, the AUM of mid cap mutual funds, I think currently is even higher than that of large cap. And valuations have, of course, run up. So there is a lot of concern around overvaluation and froth in the market. I think as of March 31st, the PE of Nifty 50 was 22.9, whereas the same for Nifty small cap 250 was 26.6, and for mid cap was 33.6. So this divergence has definitely increased the attractiveness of large cap and also increased the margin of safety. Larger companies are stronger fundamentally and far more resilient during any economic uncertainties, and some of which we have seen lately, like inflation, geopolitical tensions, interest rates, etc. That being said, I think we will be seeing a lot of FI flows also in India in future. Traditionally, this has been in the large cap segment, but in the last few years, they've also made large investments in the mid and small cap. So should one redeem and invest in mid and small cap and invest in large cap? I think it's important to stick to your asset allocation based on your risk-taking ability and time to goal. Only redeem if your portfolio has become heavily skewed towards mid and small caps and you need to rebalance. I think if we come to the current NFO that is there, it's basically a smart beta strategy which combines the benefit of active and passive investing, and because it is based on an index, it's easily back tested to see how it performs during different market cycles. So, in this NFO, of course, we have some amount of that background as well. And an equal weighted index, of course, does better than a market weighted index during a broader rally when, especially smaller stocks actually perform well. So I feel this obviously being a very concentrated strategy, within the large cap allocation, maybe one can look at a 15 to 20% allocation to such a strategy. But I would only recommend this strategy to, those investors who are knowledgeable and understand how various factors work and how this would work in various market conditions. And of course, have a higher risk tolerance.
Got it. Point well taken, Salonee. Thanks for that really lovely explanation. Now, Kalpen, the other aspect, you mentioned that you are launching, or you would think of launching an NFO in pockets which have underperformed maybe at times, because reversion to mean is that iron mantra for the markets. I was looking at some statistic from one of your newsletters which said that over the last 6 years, large cap active funds have received less than 1 out of the 10 rupees of net inflows into active funds. So is that the other reason? I mean, there is a bit of not shunning really, but a big preference towards mid caps and small caps, and therefore the large caps may have fallen out of favor. And at some point of time, by virtue of fundamental performance as well as money flows put together, large caps may actually gain prominence in portfolios over the course of the next 2-3 years?
Absolutely. I think you said it, Neeraj. And another important point is people are not investing in small and mid caps because they want to invest in small and mid caps. They are investing in small and mid caps because the past performance has been significantly superior in the last few years, especially post-COVID lows, or even since 2013. Now remember, 2013 till today, if small and mid caps have earned around 20% return, it was also because 2008 to 2013, the small cap index or the mid cap index had given 0 to negative returns. So the past setup is very important to determine what the future returns would be. And clearly in the last 5 years, partly operating performance of small and mid cap companies have improved. And other part is more flows chasing companies with relatively less free float, which is why the valuations have started showing a premium to large caps versus typically always in the history of our markets, small caps have been at a discount. We are also operating a very different template compared to rest of the world. In rest of the world, the small and mid caps are far cheaper. They are closer to 10, 12, 13 times price to earning. In India, they are in the range of 30 to 35. So my perspective is always never do market cap based investing. Buy good companies at good prices. It so happens that because of our nuances in the last 5 years, retail money has allocated more capital to small and mid caps, and relatively large institutional money, which or FI money, has moved out of large caps because a lot of FIs have been moving out of India in the last 4 years. A lot of selling has happened, especially in banking stocks. So that's where it is presenting a tactical dichotomy or a tactical opportunity where large caps are, I won't say they are cheap because nothing is cheap. At 22, 23 times, nothing is cheap, right? Long-term averages of our markets are 16, 17. So we are definitely at a premium to our past history. We are at a premium to every other market in the world, partly deserving, partly froth in terms of flows. But we feel comfortable to say that relatively the large cap universe, whether actively managed or through passive funds, is an area where we should not reduce our weights. We should only increase our weights. Second point I would clarify is instead of buying small and mid cap stocks without knowing the fundamentals or the quality of those businesses, if at all you want to be in that bucket, come via small cap funds, via active small cap funds, because this is a statistic we had presented some time back that 85% of small cap companies in the index are poor companies. Their ROEs are closer to single digit. They are not necessarily the best of businesses. So it's better to invest in small caps only through funds and not buy them directly. Last point, 2008 till today, 16 years have crossed. The return of the small cap index, which is the combination of all small cap stocks which are available in the market, is single digit in spite of today's premium or sharp rises. So you can have prolonged periods of underperformance if you are in bad small cap companies. And the only way to solve for that is not to be in bad small cap companies, either via active small cap funds or by increasing your weights in large or flexi cap sort of portfolios.
Okay, well, we need to slip into a break though on this note. Or actually, Salonee, just before we take that break, very quick 30-second view, Salonee. I heard you say that people should swap into an NFO or any large cap fund only if under certain conditions. But if for new investors, Salonee, would a large cap fund be preferred at the current point of time versus a mid cap or a small cap fund, or not necessarily so?
So I think that would a lot of it would depend on how much risk they're comfortable taking and what is the duration they want to remain invested in. So, for anyone who's looking at maybe a 5-year period, then I think only large cap and flexi cap, or regardless of the risk profile, would be a segment to look at in the equity allocation. For anyone who's looking at 5 to 7 years, can add a little bit of a mid cap. And for anyone who's looking at a holding period of more than 7 to 8 years and is aggressive in terms of the risk they're comfortable taking, then they can add small cap and maybe international funds as well. So I think a lot of it would depend on how comfortable you are with various levels of risk and what is the time that you have to invest and keep those funds invested.
Kalpen, I don't know if the thought process at the DSP equity team is slightly different, but the few investor conferences that we've attended in the recent past seems to suggest that industrials and the capex theme is the one to bet on in India over the course of the next 5-6 years, with private capex hopefully set to take up the baton after public capex or the government capex has been very strong. Now, if you agree with this, Kalpen, how is it that an average mutual fund investor tries to make most of this? Any thoughts here?
So I don't want to get into whether we are different or not. What is important is we are correct. And as long as we are not correct, nothing matters to the investor. So on this particular concept of private capex or industrials, it's not today that we're talking about it. We relaunched our Tiger Fund in January 2021, almost 3.5 years back, as an old fund offer. We brought it back to the market with a lot of fanfare. But the prior 5 or 10-year returns were looking so mediocre compared to all the other hot themes at that point in time that we really did not get investor interest or market interest. And this fund in the last 4 years has given reasonably superlative returns, including last 1 year. The whole theme has given, not just this fund. So all other funds in the same space have done very well. We agree with the fact that private capex should happen, and we are seeing gradually improvement in those numbers. But the question to ask is, are valuations not aware of it? Is the market not aware of it? And if the whole market is aware of it, is it priced in or not? So clearly, we recognize that this is a great space for companies, for investors in India to be in. But a lot of these companies have crossed 40, 50, 60, 70, 80 multiples. So a lot of good news is also getting priced in. And which is why if investors have to participate in themes like this, they need to be with an agile, active fund manager who also respects valuation. The biggest accidents, Neeraj, have happened when we buy a theme without asking questions of risk management. The same theme was very popular in 2008, where all narratives in all type of conferences were that India will become like China. So go and buy infrastructure funds. From 2008 till 2020, these funds, or even from 2008 till today, the category has earned less than savings account returns. So the second dimension to always ask is that, are you going to participate in this theme with all the guardrails of right valuations and not blindly jump into this theme? So just to give an example, in our Tiger Fund, we picked up defense stocks 4 years back, even before geopolitical situation in the world started getting volatile. And some of these stocks were at single-digit PE. Today they are at 40, 45 PE. So our weights from 20% have come down to 6, 7%. So we are being very active in this pocket. And we've been also encouraging investors to do long-term SIPs from where we are today. 3 years back, we encouraged aggressive lump sum participation in this theme. We continue to be positive in terms of growth prospects and revenue growth prospects. But valuations are something that are a bit concerning, and you need to be conscious of that as an investor.
Mm-hmm. Okay, Kalpen, we will leave it at that. Thank you so much for taking the time out and being with us today on the Mutual Fund Show and giving us your thoughts. Really appreciate your time.
Thank you.
All right. That's the view from Kalpen Parekh of DSP. Salonee, same question to you really. Do you believe that the capex theme will create wealth? And if so, is there a mutual fund route to play this?
So industrials are highly correlated to economic growth, delivering high returns when the economy does well and performing poorly if the economy doesn't do as well. Timing is definitely important when investing in this sector. We have the government's goal of making India 10 trillion economy by 2030. So I definitely think that we're on a cusp of a large capex cycle. Without that capex, we would not be able to see and reach that kind of growth. Currently, the capex, of course, and as Kalpen mentioned and you mentioned as well, capex has primarily been driven by government spending. Once the private capex kicks in, that will be a huge added tailwind as well. One way of getting exposure and investing in this theme is via infrastructure funds. There are currently around 19 funds with an AUM of almost 52,000 crores. Of course, most large and flexi cap funds have an exposure of around 10 to 12%. But for people who want an added exposure to this segment, they can definitely look at these infrastructure funds. I think one thing that people have to keep in mind is that these are far more volatile because it's a thematic fund. So this would form a part of a satellite portfolio and not part of the core portfolio. I think a couple of funds in the sector which have a high allocation to industrial specifically in the infrastructure segment and have performed well over a longer period of time is Invesco India Infrastructure Fund and of course the DSP Tiger Fund. So these are some of the funds that people can look at.
Okay. Now, a couple of queries, Salonee, if you will, because a lot of people want answers to their specific questions. I would urge you to try and see if you can answer some of these. I'll try and make it as simple as I can for you. The first query is from Arpita, who is 55 years of age. Arpita wants to invest 30,000 rupees per month for 48 months as she is closer to retirement at 55 years. What should be her fund mix?
Right. So I think it's difficult to recommend the exact right asset allocation without knowing how comfortable she is with various levels of risk. But since she has around 4 years to go, I'm assuming before retirement, I would recommend keeping at least 1 year expenses in a debt mutual fund or an FD. Another 2 years, expenses can be invested in a multi-asset or a balanced advantage category. And the rest of the funds can be invested between maybe two funds from, from either an index fund or a flexi cap category. So that's how I would look at, asset allocation in her case, since she is very close to retirement.
Okay. Well, Arpita, I hope you got your answer. But remember, it might be good for you, Arpita, with the sums that you're talking about, to consult a financial advisor, because Salonee is right. Without knowing complete details, it's very difficult to give specifics of what the fund names could be as well. So I do hope you find a good, solid financial advisor to try and tell you how to go about doing this. It might be a cost that is well worth it. Salonee, the next question is from Hari. Hari is age 41 years, is investing 5,000 rupees per month in each of the SBI Nifty 50, Parekh Flexi Cap and HDFC Mid Cap Fund. Is Hari going in the right direction for the next 15 years?
Again, without knowing more details, it's hard to comment on the split between the large and mid cap segment. But given that Hari has a longer time frame or 15-year horizon, he can afford to take a little more risk. But prima facie, I think all the three funds are good funds in their respective segments. So he can continue investing in those.
Got it. Well, unfortunately, we're out of time completely on this show. But Salonee, such a pleasure talking to you. Been a while, so good to have you back. Thanks for being on the show today.
Thank you so much, Neeraj. It was great to be on the show.
Thank you. And viewers, thanks for tuning into this leg of the Mutual Fund Show.